the confusing parts over this past, let's call it since the global financial crisis that has thrown a lot of people off, is that they assume money printing must be inflationary. Whereas another way of looking at it is that it can be anti-deflationary.
Right.
That you don't so you don't assume that the base case is like roughly zero inflation. You might assume the base case is deflation in a certain type of environment, like a big debt bubble going off. And when you expand the monetary base, you set off a series of changes that prevent that deflation from happening, which is, it's another type of inflation, but it's not something we would generally think of as inflation.
One of my big themes since 2020 was that the fiscal policy we are seeing this decade will be inflationary and that, unlike recent business cycles, interest rates may not be the best policy tool to deal with that inflation. And while that has been correct, the challenge has been navigating the specific path as we go through the various twists and turns of such an unusual macroeconomic environment, says independent investor and macro analyst Lyn Alden. According to Lyn Alden, when sovereign debt is low and most money creation comes from bank lending, higher interest rates do exactly what we expect them to do: slow down loan creation and inflation. However, when sovereign debt is high and as much money creation comes from fiscal deficits as it does from bank lending, then it becomes a tug of war. Higher interest rates have mixed effects, as they do suppress private sector lending, but also increase the deficit by a similar degree. But when sovereign debt is extraordinarily high and far more money creation comes from fiscal deficits than from bank lending, higher interest rates can become outright positively correlated with inflation. Alice has gone through the looking glass and everything is flipped. The United States is approximately in the second category. We're on the precipice. Annual fiscal deficits already exceed annual loan creation in dollar size, but due to the muted propensity to spend interest income, the two forces seem to be roughly tied and possibly still leaning towards loan creation having more weight. Let us now get into the video as Lyn Alden talks about monetary policies, the inflation and deflation system, and the pegging of the Bitcoin to dollar proposal. As you watch, don't forget to hit the like button, subscribe, and drop your comments below.
Generally, what these environments shared is that, leading up to the Great Depression and leading up to 2008, you had a situation where the um, the multipliers were very significant, meaning that the number of deposits that a bank had that they owed liabilities in compared to how much base cash they had was very wide, um, and also
But
how
how are
much
you measuring that cash?
different ways. You can either look at just deposits in the system compared to the monetary base, or you can look at deposits in the system compared to the amount of money that banks list as cash, which is either vault cash or bank reserves. If you're on like an older money standard where say the money is gold, right? If something unravels this big debt environment, you can't print more gold. So you're going to have some sort of peg break. You're going to have some sort of deflation, either deflationary collapse or peg break. It's kind of your options start to condense down. Whereas what makes this money printing essentially is that now authorities have flexibility over the monetary base. So the third option is basically instead of a peg break, they can maintain those claims because they increase the monetary base and they make banks less reliant on interbank lending. But then it kind of retroactively makes all of their deposit growth and their fractional reserve banking, it kind of solidifies that. It says that is now, we've given the choice between M2 starting to collapse down closer to the monetary base or the monetary base expanding upward to meet M2. They basically say that we will always err on the side of, the monetary base expanding upwards to make most M2 money good. What you generally have in these crisis environments is that you have an inherently unstable system. Like, basically that no more than 5% of people could want to withdraw cash at once because just there's really not the base cash isn't there. There's only so much base cash. If the whole system's only levered so that there's basically like back in 2008 there were like 23 deposits for every $1 in what banks called their cash, which is like vault
Right.
cash combined with some reserves. Now, if any one bank, let's say one bank had 20% of deposits want to come out of it in one day for some reason, maybe they have a really big concentrated depositor. That bank could meet that no problem by going over to Wells Fargo and saying, "Hey, we just got to meet this like liquidity requirement." Um, but if the whole banking system were to one seize up, so they can't, they don't trust each other anymore, and
But
they
that's
can't.
an increase in counterparty risk.
Yes, because the reason it happens is because they realize like that the money's not actually there, or at least most of the money's not actually there. So if the music stops, and if say 10% of the whole deposit base shows up and says, "Oh, okay, I want my dollars right now," there's literally one is there's not even enough printed dollars, and two, even if you include reserves and things like that, there's not that many base dollars.
Democratic presidential candidate Robert F. Kennedy Jr. is sharing his plans for Bitcoin if he gets elected in the November 2024 election. During a speech at a Heal the Divide event, the nephew of former President John F. Kennedy says his administration will exempt the conversion of Bitcoin to dollars from capital gains tax. He says there are downsides to this policy, but the U.S. will reap benefits that can dwarf the disadvantages. Kennedy says removing taxes on the flagship crypto asset will help protect civil liberties. The environmental lawyer says the idea is similar to the Clinton administration's policy that exempted e-commerce from taxes. Kennedy says he also wants the US dollar to be backed with Bitcoin, through which the king crypto can help save the greenback. Lyn Alden shares her views regarding the proposal. Let us now listen to what Lyn has to say.
Because there's a difference between reserve accumulation and actual backing. So reserve accumulation would basically say, okay, our Federal Reserve is going to be, and Treasury, actually more specifically, is going to be allowed to and even tasked with increasing its hard assets, right? So you say, okay, instead of just holding our 8,000, supposed 8,000 tons of gold flat, we want to go out and buy more. And, we want to add a certain percentage of Bitcoin to that mix as well, so that there's more reserves in the system. That's one statement. I think it's an arguably reasonable thing to do. I mean, it's probably dollar negative while it happens, um, but then they'd have more ammo if they should ever want to defend the dollar. That's just generally how emerging markets manage their exchange rate. Is they either one of the things they do is expand reserves or contract reserves. So that's an option. Now, if you actually wanted to back it in terms of redeemability, the challenge is that you have to have quite a lot of it. So
Yeah,
the way this
yeah,
would work on the gold standard, for example, is that you might have 40% of your monetary base backed up by gold. And if there's too many redemptions happening, that's what you'd have to increase interest rates, because you want to entice more gold to enter into your, or at least you want to stop the outflows and entice more existing gold to come back in, for people that say, okay, I trust the system and I want to get that higher interest on that gold by depositing it. And then if they're ever in a situation where they have more gold than they need, let's say they have 50% and their mandate's 40%, they can cut interest rates, because it doesn't matter if there's a little bit more redemptions happening. But you can't generally do that when you're talking about 1%, 5%. And the longer term challenge goes back to our earlier point about fractional reserve banking, and how these claims tend to proliferate faster than the underlying base can.
right.
And so when you have banks that are not full reserve banks, so they're not doing duration matching, they're doing fractional reserve banking, they're generally increasing the total claims in the system more than gold's increasing. And so as long as that's redeemable, you're probably going to get drained. If you look at the Bretton Woods system, it's interesting because it was proposed in obviously 1944, but it wasn't fully implemented until the late 1950s. That's when like it was fully set up. The exchange rates were um,
We're
like all,
locked.
all yeah, all that stuff was like, yeah, it was kind of all planned for like that first like 15 years, and then it was like, okay, we're going live. And if you look at U.S. gold reserves, they just started dropping almost every single year like a stone.
Yeah,
As soon as you had that, until it just broke. Then they said we can't do this anymore. So a lot of people, when they look at the Bretton Woods system, they say the problem happened in 1971. It's like, well, no, the problem happened the second you went live with a system that didn't fundamentally make sense, because you didn't constrain the number of IOUs, bank deposits. You didn't constrain the number of euro dollars. So you had fractional reserve banking built on fractional reserve banking. This was all
no
proliferating,
reserve
and
banking,
yeah,
for
and
heaven's
all
sake.
this was yeah, and all this is now redeemable for gold. And so people kept saying, well, I'll take the gold then. So you started rapidly draining gold while increasing M2 and increasing euro dollars, and eventually the ratios got silly and broke.
El Salvador's bonds due in 2027 have risen by over 60% since the start of the year, in parallel with a price surge for Bitcoin that's seen the cryptocurrency rise by 80%. A government bond represents a debt that is issued by the government and sold to investors to support government spending. Back in September 2022, credit rating company Fitch Ratings lowered El Salvador's debt rating and predicted that a debt default would take place in January 2023. A debt default occurs when a borrower cannot repay loans they have taken, meaning that El Salvador would not have been able to pay bondholders. Not only did this not happen, but the country repaid a $800 million bond in January. Since then, the country's bonds have soared alongside Bitcoin, though other factors are at play, with investors lauding the appointment of former IMF official Alejandro Werner as an advisor to the finance ministry. El Salvador made Bitcoin a legal tender in September 2021. Since then, the country has seen mixed results. Tourism has increased, but reports indicate that not many citizens use cryptocurrency. According to Bloomberg, the country holds 2,546 Bitcoin, worth roughly $76.6 million. Bitcoin has rallied by over 80% since the start of January as a result of multiple factors. Recent bullish events include the Federal Reserve pausing on the latest interest rate hike and BlackRock's application to launch a spot Bitcoin ETF. U.S. senators remain wary of El Salvador's drive to adopt Bitcoin. A U.S. Foreign Relations Committee blog post from May says, "We must seek greater clarity on how the adoption of Bitcoin as legal tender may impact El Salvador's financial and economic stability, as well as El Salvador's capacity to effectively combat money laundering and illicit finances." The move by El Salvador and the resulting consequence show the increasing desire by institutions to integrate Bitcoin into their finances. Do you think a Bitcoin-pegged dollar is feasible? Let us know your thoughts in the comment section below. Also, don't forget to hit that like button, subscribe, and turn on notifications. Thanks for watching.